Hey everyone, it's Wolfgang. I want to provide an update on the economy, and I want to talk about investing in the private credit market and what the private credit market is. This is related to my video from yesterday, real estate scaling with the right loans. If you look on my channel at the video I posted yesterday, I talked about what happened after the 2008 and 9 crash, economic crash, and how it affected investors in real estate. I invest in real estate among other things, like a lot of you. So this is kind of a follow-on because the private credit market was also boosted by the 2008 and 2009 crash. But first, an update on the economy. Home sales are the lowest in 5 years. Homes are sitting on the market for longer than normal. And interest rates at 7% is part of the problem. Prices, though, low affordability is another big part of the problem for home sales. So it's been 5 years since home sales have been this low in the month of January. And the other thing I wanted to mention about the economy is the Fed. Recall that there's been a little bit of friction, I guess, between Powell and the new administration that came into the government. There's been a little bit of friction. So the backstory for that is the previous administration stressed hiring for government jobs. And the employment numbers that the Fed has been looking at up until the new government came in, the numbers that the Fed has been looking at in terms of adjusting interest rates has been affected by government employment. And that has sort of skewed their decision making because there's two employment markets in the United States. There's the public sector employment, which is the government, and there's the private sector employment, which is much, much larger. The private sector employment market is people who work at companies, people who are employees at private businesses and corporations. So the Fed is being forced to shift focus to support, to provide better support to private sector unemployment because that is high, relatively speaking. And the way this is coming about, it's a little bit sneaky, but at least in my opinion, it appears to be a little bit sneaky. The public sector employment is being reduced, and people in the private sector are going to start representing a larger share of the workforce because the number of government jobs is dropping. The number of private jobs will start to loom large for the Fed when they look at employment numbers. So what's sort of happening behind the scenes is the Federal Reserve will start to have to cater more to the private sector unemployment market. I don't know if you've been tracking this, but if you have a job right now, you're probably concerned about the economy and how stable your job is, and you're definitely not thinking about quitting. If you compare that to COVID days when it was a lot easier to get a job, that has changed. Now it's not as easy to get a job. So private sector unemployment is going to start playing a bigger role in the Fed decision-making process about interest rates. So we sort of expect interest rates will change. Right now, everyone thinks interest rates are stuck and they're not going to adjust them. I think what's going to happen is as the government employment drops, it will become clear that private sector employment is soft and it needs to be fixed, and the Fed will lower interest rates to make that happen. That's what I think. So there's just those two economic updates, home sales and a change in the background of what the Fed will look at when they consider unemployment, because the Fed has two mandates, stable prices and maximum employment for the economy. So the unemployment for the private sector has been poor, pretty poor. Government sector, those jobs are, the government really doesn't produce any products or services. The private sector produces the products and the services for our economy. That's just a fact of life. The government jobs are basically, they don't really produce innovation either. If you think about it, your phone, your Apple phone, is not a government, it was not invented by the government. It was invented by a private company. So the private sector unemployment has been soft, and that's going to be catered to going forward. And I think the Federal Reserve will start lowering rates faster than people think because of this change, because the government unemployment, the number of people employed in the government is dropping, right? So we see that happening. Okay, so let me switch to investing in private credit. After the 2008 and 2009 crash, I talked about this yesterday in my video, Real Estate Scaling with the Right Loans. In the 2008 and 9 crash, tighter bank lending oversight came into be for lending. It became harder to get loans. If you were buying rental properties, you suddenly noticed it became much more difficult to get a bank loan to expand. If you want to learn how to get around that, see yesterday's video, Real Estate Scaling with the Right Loans. I covered that. So this is a related issue. Instead of real estate investors being the borrowers, which I covered in yesterday's video, in this case for private credit, the borrowers are companies, private businesses in the U.S. After the 2008-9 crash, mid-market U.S. companies could not get loans. It became much more difficult to get funding and financing for their businesses. Mid-market companies have generally 10 million to 150 million in EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. So after the 2008-9 crash, these companies didn't go away. They still needed debt. They still needed to borrow money to finance their business projects, etc. Private debt and lenders took off after that. Yesterday, I talked about the change. I talked about how real estate investors were able to pick up the pieces after the crash and start getting loans again. I talked about how that happened and how you can do that. Companies, these are not real estate investors. These are businesses that are producing products and services, began getting loans from private debt lenders. Right now, there's $2 trillion assets under management for these private debt companies, for these private credit, in the private credit market. Private credit and private debt, same thing. It's just a different way of saying the same thing. It's non-bank lending. Private credit or private debt, it's getting a loan from a non-bank entity. So after the 2008-9 crash, demand for borrowing did not change. There were still all those companies who needed loans. They couldn't get them. And whenever there's demand, a supply will be provided by somebody, by some groups. So the supply had been there. There's always been a pretty small private credit market. But after the 2008-9 crash, it really took off because all of a sudden there were tons of companies who could not get bank loans anymore. So interest rates for these loans right now, somewhere around 12% plus or minus. The interest rates are higher. And the oversight, the government oversight of private credit lenders, the government oversight is lower. There's less oversight, so there's slightly higher risk in private credit. If you invest in private credit, what can I compare this to? Let me GoFundMe, crowdsourcing, or there was a company online that allowed you to lend money to individuals online. I can't remember the name of that company, but it's sort of like that. There are new ways to lend money, and this is one of them. The private credit market is just another way to lend money. Interest rates are higher. The risk for investors in private credit is higher. So the way this works is as follows. There are people who want to invest money granting loans to other people. There are companies who take the money from those investors and qualify borrowers. They check the background of the borrowers to make sure they're up to snuff, and then they make the loans. So there's three parties involved. There's the borrower who's borrowing the money. There's the investor who's lending the money, and then the middleman, the private credit lender, is raising the investor money and then qualifying the people who borrow, making sure they can pay the loans back. So it's there's three parties involved in this market, and if you're an investor in private credit, in the private credit market, you've got to be an accredited investor. So the returns can be higher, 12%. If you compare that to the 10-year U.S. Treasury right now is paying this year, right around 4.5%. The 10-year Treasury right now is right around 4.5%. So 12% looks pretty good, right? You've got to be an accredited investor. So accredited investor, I want to make sure I describe this correctly because I can usually say it off the top of my head, but I want to make sure I nail it. So accredited investors, annual income of $200,000 a year, or for an individual, or if you're married, an annual income of $300,000 jointly, or a net worth of $1 million, not including your primary residence, or if you're a qualified financial professional, if you're in the business already, you can become an accredited investor. So the returns are higher, there's a little more risk, and you need to be an accredited investor. So private credit loans are different from bank loans. If a company needs to borrow money, and they decide to use the private credit market, they will approach a private credit lender, and I'm going to give you a list of those lenders. They will approach one of them, and they will they will say, I need X number of dollars, and we will allow you to take a 5 or 10% stake in our business. We want you to give us $1 million for a loan, and we will allow you to take an equity stake, a 5, 10%, 15%, whatever they negotiate, equity stake. So private credit loans are customized to fit the borrower. If a company is borrowing money, they can offer as an enticement, as an inducement to the lender, an equity stake in their business. So banks can't do that. Banks are regulated. After 2008 and 2009, getting a bank loan, there's a lot of micromanaging of the banks as far as lending goes. There's a lot of regulatory oversight. The private credit market, though, can customize loans to meet the needs of the borrower, including allowing the private credit lender to take an equity position, an equity stake in the company. So that was not possible it's not possible with regular bank loans. So what are the opportunities in this market? You can invest in private credit platforms. There's several platforms that are available for investors to invest in. So let me give you some of the names. This is not an exhaustive list, but okay. So one private credit investment platform is called Percent. They have over 1 billion assets under management. Minimum investment $500. Yield Street or Yield Tree, 4.6 billion assets under management. Minimum investment's $10,000. Apollo Global has a private credit lending platform you can put investment money into. KKR, Blackstone, the Carlyle Group, Oak Tree, Goldman Sachs Asset Management. So there's a bunch of, if you just go online and search, how do I invest in private credit, you can get a list of these companies, and you can find out what they require for their investors. So you can invest in private credit platforms. You can get higher yields. They're lending out money up to 12% in an environment where the 10-year Treasury is only paying 4.5%, right? So higher yields to investors. And the one of the key points about this type of investing, if you invest in these private credit platforms, they're not correlated to public markets. So let me just mention something about what I mean by that. In the 2001 dot-com bubble burst, the public stock market crashed hard. The public stocks lost a lot of value. It was quite easy to see the loss in wealth in the public markets. You would just go to your online broker, and you could see that, okay, Amazon has fallen 90%, right? Because I think Amazon actually did fall 90%, and they didn't recover for 10 years after the 2001 dot-com bubble burst, even though it was a healthy company. I mean, it was a company that was being operated correctly, and they still lost a lot of market value. The private companies who are not listed on an exchange, there are a lot of reasons why, but the point I'm trying to make here is, if you're an investor in private credit to private companies that are not on the stock exchange, those companies are not directly correlated. There's not a tight correlation with the public markets because they're not public companies. These are the private credit lenders lend money to private companies who are not, they don't have publicly traded stocks. So there's, for some investors, this is a benefit. This is a desirable thing. A non-correlated investment means there's some diversification. If you're invested in the public market, like public stocks, and there's a big crash, you might find that your investment in this case, this is debt. We're investing in loans, right? When you invest in a private credit platform, you're basically lending money to someone, and you're relying on this middleman, this private credit lender, to facilitate your investment for you, and they get a cut for that. But it can be advantageous to have non-correlated to public market investments. It's just another way to diversify. So let me mention who invests in private credit. Institutional investors like pension funds, asset managers, lots of different types of those. Individuals invest in these private credit platforms, family offices. So generally the way it works is you have capital to invest. You can demonstrate that you're an accredited investor, and then you allocate a portion of your investment portfolio to one of these private credit lenders, like the list I just went through. Let me go through this again. Percent, Yield Street, Apollo Global, KKR, Blackstone, the Carlyle Group, Goldman Sachs Asset Management, Oak Tree. There's another one called Ares, ARES, and there are others. So basically, a lot of different types of, a lot of different parties are investing in these private credit lenders. So the benefits, I mentioned a couple of these already. The loan that gets made to a company, it can be tailored differently for every borrower. Every company can have a customized loan set up for them by these platforms. The platform can work with the company and that's borrowing the money, can work with them and figure out a way to customize the loan to that particular company's situation. Banks can't do that. Banks are regulated. They have very strict guidelines they have to follow when they lend money. And okay, so there's less correlation to the public asset markets. That's good for diversification. I mentioned that. Higher returns are possible in the low interest rate environment like we have now. We've got relatively low 10-year interest rates, 4.5%. So it's right around there. If you look, I think it's right around 4.5% on the 10-year Treasury. So getting a 12% return, that's obviously a higher return. So higher returns are possible in a low interest rate environment. Now here's a caveat. This deals with the secondary market. So let me explain what a secondary market is. Let's say that you are you work at a high-tech company, you're a software engineer, and you go to work for the company. It's a software company, it's a startup, before they go public. So part of your compensation package is a share of the company's stock given to you over the course of a 4-year, typically it's 4 years, a 4-year vesting period. So every year, the company gives you a certain amount of stock to keep you interested in doing a great job for the company. So in that situation, until recently, there was no secondary market. If you decided after 2 years, I want to quit the startup, I've got another opportunity, you were kind of screwed because there was no way to sell the shares that you had vested. There's until the last few years, there are new companies that help those people sell their vested stock on a secondary market. Another example of a secondary market is the public stock market. You can sell your stocks. You can log into your broker and sell your stock holdings pretty quickly online these days. You're selling your stock into a secondary market. The secondary market, in that case, is not the people who bought the stock when it first IPO'd, when it first went public. The secondary market is people who just want to buy that stock potentially long after it went public. So with private credit markets, there is no secondary market. So you hold, if you make an investment, you hold the investment to maturity. Now the loans, how quickly those loans mature can vary because the loans are flexible. They're tailored to the borrower. But this is something to keep in mind. There's no secondary market. Once you make the investment, you're in it for until it matures, until the investment matures. So I covered a fair amount of ground here, but private credit market lending, I wanted to mention this because it's related to my video yesterday, real estate scaling with the right loans. After the 2008 and 9 crash, there was still demand for loans from real estate investors. There was still demand for loans from these companies. And all of a sudden, everyone was getting locked out of the debt market. The private credit market kind of took off after that. And so this is sort of a background on what's going on there and what the investment opportunities are. If you have any questions, you can post those in the comments and I'll try to answer them. But I want to thank everyone for watching and have a great day.